C. So we have a contribution of appreciated property, and we have our methods for dealing with 704C allocations, traditional with curative, and remedial allocations. And we talked about the 4 or 5-step approach. It's pretty straightforward. Today, when we dealt with last class, we dealt with non-depreciable property. So things like land or inventory are non-depreciable. And that means that the 704C sort of reconciliation, if you will, is going to happen at the end, when the property is disposed of by the partnership. Next question is, what if the 704C property is depreciable property? So depreciable property, things like equipment or machinery, you have tax depreciation on the equipment, let's say, and you have book depreciation on the equipment. So and remember, step 1 in all of the methods is to calculate your book and your tax depreciation. So that leads to the question is, how do we determine depreciation on property that's contributed to a partnership? From tax 1, when you buy property that's depreciable, there's a schedule, the depreciation schedule that you have on the property. And it could be in a method, straight line, 5-year, 7-year, accelerated depreciation, so on and so forth. What do we do about property that's contributed to a partnership? So there are 2 rules there. Let's turn to the code. Let's turn first to section 168I7. 168I7. The heading is treatment of certain transferees. So 168 is the rule for depreciation of property. And this provides a rule. It's a little bit confusing. It says in the case of any property transferred in a transaction described in subparagraph B, well, subparagraph B includes section 721, contributions to a partnership. The transferee, the partnership, shall be treated as a transferor for purposes of computing the depreciation deduction. So that just means that the partnership steps into the shoes of the contributor. So if the contributor was on a 10-year straight line depreciation schedule, whatever depreciation, whatever years are left, you continue on straight line. So you sort of just continue on the depreciation schedule that existed in the transferor's hands. That becomes the depreciation schedule in the transferee, the partnership's hands. Step into the shoes approach. So that means if it's, and in this class, we're always going to be using straight line depreciation. So what that means is that if it was a 10-year straight line and it's contributed after year 4, you'd have 5 years left, 6 years left, 6 years left. And so you would just depreciate the rest on the remaining 6 years. So you would just need to know effectively what's the remaining years in the depreciation schedule. And you would divide it by that number of years. So if you have 60 of basis and you have 6 years left in the depreciation schedule, your tax depreciation will be 10 per year, which is what it was if the transferor, the partner, had held onto the property. So it just continues on along. And that's kind of maybe intuitive, right? It's a non-recognition transaction, 721. We just keep on chugging along with the same depreciation schedule. Okay, any questions on that? That's the tax depreciation. Now we have book depreciation. Now this is a little less intuitive because the book value is going to be different than the tax value, obviously, because we're here in 704C. And so how do you depreciate the book value? Well, that rule is found in the regs under maintenance of capital accounts. It's a capital account rule. It's the books, the 704B book rules. So that's found in, remember our good friend 1.704-1B2 4 little i's is our capital account maintenance rules. -1B2 4 little i's. We're going to go to -1B2 4 little i's G3. -1 B2 4 little i's G3. G, the heading is adjustments to reflect book value. But the rule here is, we're looking at determination of book items. And it says the partner's capital account will not be considered adjusted in accordance with this paragraph unless the amount of book depreciation or amortization. Amortization refers to depreciation on intangible value, like goodwill. So book depreciation, book amortization, depletion refers to like oil and gas stuff. We're not going to deal with oil and gas. So the book depreciation for a period with respect to an item of partnership property is the amount that bears the same relationship to the book value of such property as the tax depreciation bears to the tax basis. So again, that's a long-winded way of basically saying that the book depreciation is going to be depreciated at the same rate as the tax depreciation. And again, for straight line, what this means is however many years are left in the depreciation schedule, you're going to divide the tax basis by that number of years to determine the yearly tax depreciation. And for book, you're going to divide the book value by that number of years to get the book depreciation. It's going to be the same rate. So you have 4 years left. You're going to divide the tax basis by 4 for each year. You're going to divide the book value by 4 for each year. That means the rate is 25% a year. And that's what's going to happen here. It's a little bit more complicated when you're dealing with accelerated depreciation. The math is trickier. Luckily, we don't have to deal with that. So that's how we calculate book depreciation generally. We're going to see that there's a confusing exception to that general rule. But for now, this is the general rule. Any questions about how we calculate book depreciation? So then once we know to calculate book and tax depreciation, we can then apply the rules for the method, the 704C methods. And let's see how we do that. So the example I'm going to use here, and there are good examples in the regs. So let's turn to the reg. This is 1.704-3. Let's turn to the -3 reg. -3B is the traditional method, which is what we'll start with. -3B. And then we've got B2. We've got these examples. So we're going to start with example 1. We have A and B. They're each being 50-50 partners of everything, except for 704C. 704C has the requirement to allocate the built-in gain in accordance with 704C principles. They're going to use a traditional method. And A is contributing depreciable property with a tax basis of 4 and a book value of 10. And B is contributing cash. The next important thing to note here is that there's got 10 years of depreciation left on a straight line basis. The problem could be clearer. This problem is not that clear. It's a little confusing. That's what it's saying, is that there's 10 years left straight line. The later problems are more clear about that. So let's see how this works. got A and B. So A is contributing property with a fair market value of 10 and a tax basis of 4. B is contributing cash of 10. We've got this depreciable property. We'll call it machinery. It has a book value of 10, a fair market value at time of contribution, an inside basis of 4. A is tax basis and machinery before, and we got cash up here too. Okay. So then we go to year 1, and we've got depreciation in year 1. And again, it could be that the property had a 20-year period, original period, and was contributed after year 10, so it's got 10 years left, but it's straight line. So that means you're going to get 4 divided by 10 each year, which is going to be 0.4 of tax depreciation every year, years 1 through 10. And book, again, it's going to be at the same rate since it's 10% a year, or another way you could do it is just divide it by the number of years remaining. It's going to be 1. So we've now calculated our book and tax items. That's step 1 in our 4 or 5 step process. 2, we allocate the book items. So that's going to be 0.5 of depreciation each year, because they're 50-50 partners. Step 3, allocate to the non-contributing partner. We're going to try to get the non-contributing partner the full amount of the book items equal to tax equal to book. But the ceiling rule says we can't give them more than we got. So we can only give B 0.4 of tax depreciation. That's all we got. The ceiling rule here applies. This is a ceiling rule limited situation. Whatever's left goes to the contributing partner. There's nothing left. That's the 4th step. The 5th step, if we had curative or remedial, we'd have another thing to do. But with traditional, we just stop and leave it there. So at the end of year 1, the book value, the capital accounts, the book capital accounts are 9.5 each. And A's tax capital account is 4, B's tax capital account is 9.6. And B isn't happy about this. I mean, this is where B would prefer another method, perhaps, because B is getting shorted 1/10 of $100 of depreciation. And just to show how this works, if we were to sell the property for 9, the next year, let's say year 2, we sell the property for 9. So our book value is now 9. Our tax basis is now 3.6. So we sell it for 9. We have no book gain. Step 1. Step 2, give the non-contributing partner book items equal to tax. Well, that's easy when there's 0. Whatever's left goes to the contributing partner, which is going to be 9. We have 5.4 of tax gain. So after the sale, A is going to get taxed on all the tax gain. And now our book tax capital accounts look like this. Now we've got 19 of cash, the 9 from the sale, 10 from the cash. We would distribute it 9.5 and 9.5. A would recognize 100 of gain on liquidation. It's going to have cash distribution in excess of basis. B, we're going to see when you liquidate your partnership interest for cash and you have more basis than cash, you have a loss. So that 100 of loss that B doesn't get here, eventually B gets on liquidation. That 100 of income that A should be getting is not lost forever. He gets it on liquidation as well. And the problem goes through this. So part one of the problem here, let's just go back. So again, this allows you to go back and redo these problems because you've got, this is, two little i's is talking about just the allocation of depreciation, and then three little i's is the sale for 9, and then four little i's talks about then if we liquidate the partnership. So everything we just did is right there in this problem. So example 1 is a really good problem. You don't have to worry about example 2. It's talking about unreasonable, sort of abusive uses of these methods. We're not going to focus on that. Okay, any questions on that problem? And so the only, this is all, go ahead.
Can you remind me why A gets all 5,400 or 5.4 of the tax gain?
Right. Well, step 1 says figure out the book and tax items. Step 2 says allocate the book items. Step 3 says give the non-contributing partner tax items equal to book items, but see the ceiling rule. Step 4 says whatever's left goes to the contributing partner. So this is whatever's left. And it's the tax gain. We have the amount realized is 9. We're selling it for 9. Our tax basis is 3.6. So that's the 5.4 of gain. So we had 0 of book gain and 5.4 of tax gain. So step 4 is what tells you that. Does that make sense?
It will eventually.
So yeah, I mean, remember, we allocated the book, we calculated the book gain and the tax gain. That's step 1. We allocated the book gain to the partners. That's step 2. Step 3, we gave B tax gain equal to book gain, 0. Step 4, whatever's left, which here is all of it, goes to the contributing partner. I mean, that's the technical reason. You're asking the conceptual reason why. What happens here is that A is getting 6 of book value, book capital count without paying any tax. So that's the 6 of gain that A should be paying. And so A is giving back 0.5 of that, and then he should be getting back 5.5, but he only had 5.4. He gets the other 100 at the end. But so this is all. The idea here is we're getting A to be taxed on that 6 of built-in gain. That is A's 6 of built-in gain, and we're not going to wait till the very end. When he sells a property, we're going to do it gradually through depreciation, and then we do it. It takes care of some of it on the sale. And sometimes with traditional, in the ceiling rule, you still don't get a perfect result. You still have some reconciliation that has to happen at the end. Okay, so that is, let's just do one other modification. Let's say same facts, except the property in A's hand had a basis of 6 instead of 4. So everything's the same. Book is still the same. B's book is still the same. A's tax capital count is 6 because the basis is now 6. And now the depreciation each year for tax is 0.6. So our book depreciation is 1. Our tax depreciation is 0.6. So we allocate the book depreciation 0.5 and 0.5. Give B full tax equal to book. Here we can do it. We're not ceiling rule limited because we have 0.6. So we give him 0.5. We match that up. That's what we're trying to do. Now whatever's left pours over to A. So of the 6 of tax depreciation, B is going to get 0.5 and A is going to get 0.1. We're not ceiling rule limited. If we then sell for 9, we would then have 0 of book gain. Okay, B gets 0 of tax gain. Whatever's left, which is 3.6, goes to A. So A gets taxed on all 3.6 of the gain. And now when we liquidate, we have no further gain or loss because when we distribute 9.5 to each, their outside basis is the same as their cash distributed, so they have no gain or loss. So we don't need, there's no reconciliation at the end, and that's because we don't have any ceiling rule problems. Because B is getting for tax exactly what he got for book. Okay, any questions on that? All right, well, let's go to another problem. Let's go to, we're going to go to, in the regs, go to dash 3C, traditional with curative. Let's go to the example dash 3C4, example 1. So again, we've got one partner who's contributing equipment with a book value and a 10, a basis of 4, 10 years remaining on its cost recovery. So that's more clear because it says remaining, using the straight line method, as we'll always use in this class. And in addition, F is contributing cash, and they're going to use the cash to buy inventory. So to draw this up, you've got E, you've got F. F is easy. F is contributing the cash. E is contributing the equipment. Fair market value of 10, tax basis of 4. So the partnership has this equipment with a book value of 10, an inside basis of 4. And the partnership also takes the 10 of cash that F contributed and buys inventory with a book value and inside basis of 10. Inventory, this inventory is not 704C property because its book value and tax basis are the same. Property purchased by the partnership is not going to be 704C property generally. We're going to see an exception. The other thing to note, inventory is not depreciable. Land is not depreciable. Inventory is not depreciable. And then we also know that when inventory is sold, it results in ordinary income or ordinary loss. Inventory is not a capital asset. So, and here they're going to use traditional with curative. And so in year 1, we've got, again, calculate the book depreciation, 10 years left. So we've got 1 per year of book depreciation and 0.4 per year of tax depreciation. So step 2, allocate the book depreciation. Again, these are 50-50 partners under the facts. Each get half the book depreciation. Give the tax depreciation to F to match his book, but we can't exceed it. So we're ceiling rule limited here. So we give him all we got. And then whatever's left here, there's nothing left, goes to the contributing partner. The other thing that happens is we're told that the inventory is sold for 10,700. So we have 700 of book and tax gain on the inventory. So we would allocate that, the 700 of book and tax gain. That's going to be 0.35, 350 to each partner. And with non-704C property, the tax just follows the book. There's no difference. So that's our year one depreciation. This is sale of the inventory. And if we use traditional method, that's it. That would be the answer. But we're told here we have traditional with curative, and the partnership agreement, can limit what you choose, what you use curative for. But here it says cure as much as you can. And we can cure because the depreciation is an ordinary deduction. The sale of the inventory is ordinary income. As long as there's that match, we can use it to cure. It's not impermissible. If this were capital gain, we couldn't cure an ordinary deduction problem with capital gain.
I have a question.
Yeah.
Why is the book gain 700 and not 1,700? I thought we were doing sale price minus the book value at the end of year one.
We're selling the inventory here. Yeah. So we're not selling the equipment, we're selling the inventory. We're holding.
Because we're not depreciating.
Yeah. I should have made, okay. The facts in the example say that we sell the inventory for 10.7. Sorry, I should have made that more clear. So at the end of year 7, we have 10.7 of cash. We still have the equipment. We're not selling the equipment. This is year 1 still. This is just illustrating curative. And so again, with traditional, that's it. With curative, what it says is once we figure out that we can cure, the key here to getting curative right is look at the non-contributing partner. And if there's a ceiling rule issue, which here there is, you're going to adjust the tax allocation for another item to offset the ceiling rule. So here, F is getting too little of tax deduction. He should get 0.5, he's only getting 0.4. So to fix that, we can have a cure and we can give him too little of ordinary income. So we change this, instead of giving him 0.35, we just give him 0.25. One way to see that is if we aggregate these two, they should sum together. So this is a net negative 0.15. This is net negative 0.15. So we've taken 0.25 of tax ordinary income away from F, which F likes, right? And the flip side is that extra of 0.1 of ordinary income is going to go to E. So again, to cure, we're going to give him 0.45 of ordinary income. So instead of splitting the 700 of ordinary income 350, 350, we're splitting it 250 and 450. And the way you can see that the ceiling rule, that we've done it right, is that afterwards, F's book and tax capital accounts are the same. E's are still different because we haven't fully resolved it. We're just sort of through the depreciation, making our way towards resolving it. So this is 9.85. Okay, so for F, he's going to get 400 of tax depreciation and 250 of ordinary income. E is going to get 450 of ordinary income.
So if you have this method set up in your agreement, are you basically stipulating that you need to make a transaction to even it out? Or are you stipulating there's going to be enough transactions, so we'll just even it out with another transaction?
Well, no. So the agreement's going to say traditional with curative. This is the method we're going to use, the traditional with curative. Whether it cures entirely depends on two things. One is, again, you can negotiate for curative being limited, and we're going to see that in a second. So E would want curative to be limited, F would want it to be unlimited. But still, even if it's unlimited, or if it's limited, if you just don't have enough items that are permissible to cure, you won't get a cure that year, a full cure that year. So if we only had, if we said we sold the inventory for, let's say we sold the inventory for 10,100 instead of 10,700, that was all we had of ordinary income, ordinary deduction, then it would be 0.05 would be allocated book. And then the cure would be, we would just give him F not, I'm sorry, it's positive, 0.05 income, it's gain. So 0.05. We would normally give F also 0.05 of taxable income, but the way the cure would be to that. In that case, we've done a partial cure. We haven't gotten all the way there. We just don't have enough if we sell for 10.2, 10.1. If we did it for 10.2, we'd be able to have enough because we did 10.2, we sold for 10,200, then we'd have 0.1, 0.1, we give 0.2. Okay, so John, so basically, if you're the partner that benefits from curative allocations here, F, there's a risk that there won't be enough curative allocations to fully ameliorate the ceiling rule, in which case you're screwed a little bit. Now you can make it up the next year, and so it depends how long it's going to be. But that's you don't contract to create. I suppose you could. You could have a duty on the manager to sell property but you typically wouldn't see that. But it says whatever you do have, we're going to allocate disproportionately to sort of resolve the ceiling rule problem as much as we can. And your intuition might be, well, that's why F might be better off with remedial. Because with remedial, we're going to resolve the ceiling rule problem because we're just going to make it up. Curative relies on there being enough other items to cure. Remedial doesn't rely on anything. But we're going to see that it's a little more complicated than that when you get into nitty-gritty details of remedial. Okay, so that is example 1 that we just went over. So now we can go down to example 2. So unreasonable here, they say, well, you can't overcure. So again, here they've cured by giving all 700 to E, which is not appropriate because they've done more than cure. They've gone too far. So again, if this was fast or you need some more time to digest, I know this stuff is tough, but you've got the problems go through it just like I did. But you don't have to worry so much about 3 to lies, but that's a pretty obvious unreasonableness. The limitations for curative are you have to use the same character and you can't sort of overcure. You do the disproportion to the extent necessary to offset the ceiling rule and no more. So here in example 2, we've got G and H, and they're each contributing property, as 704C property. G's, they both have a book value of 10. G's tax basis is 3. H's tax basis is 6. And so we've got the depreciation on each one, and they each have 10 years remaining. I'm sorry, they each have 5 years remaining. And there's also this $1,000 of operating income that's there too. So depreciation on each of the 2 items is operating income. Net operating income, it's basically our operating income less all other expenses other than depreciation. And they're going to use curative, but they're going to limit it. The partners have agreed that they're only going to cure with depreciation. They're not going to cure with other items, even if they can. Because operating income is ordinary income, so they could conceivably cure with operating income, but they've decided to limit it to only depreciation. So let's see how this works. And we've got G1 is property contributed by G. And H1, property contributed by H. So they each have, it's 5 years left in the recovery period. So you divide the tax basis by 5, so you're going to get 0.6 per year on the tax basis, and 2 a book on H2, and 1.2 of tax depreciation on H1. So for year 1, the G1 depreciation, we allocate the book 1 each. We find the non-contributing partner. So H is a non-contributing partner with respect to G1. We're going to try to give H1 of tax depreciation, but we only have 0.6 to give. Whatever's left goes to G, and nothing else left. Year 2, we haven't yet done the cure, but let's do what we would do under a traditional, and then we'll see the cure. Again, 1 a book to each. The non-contributing partner is G with respect to H1. So give him 1 of tax, and we give H 0.2, whatever is left, 0.2. Then we've got the operating income, which is 1,000. It's just split 0.5. So operating income, 0.5. And again, that's not 704C gain, so book tax just follows book. And with traditional, we just deal with this. Again, H isn't happy because H is ceiling rule limited here. So now if they're allowed to use, if they're using curative, but they're only looking to depreciation to do the cure, then again, the cure is going to be, okay, look at H. He's getting shortchanged 0.4 of tax depreciation. Ceiling rule limited. So let's give him 0.4 more of tax depreciation from H1. We can't give him more from G1. That's the ceiling rule. We go look to depreciation of other property. And so we got depreciation on H1. We can give him another 0.4. So we're going to change this, make this 0.6. Go from 0.4, 0.2 to 0.6. And we're taking it away from G. Again, it's a little bit harder to see the correction here because you can't use what I said before, which is you can just sum it together because H has its own 704C issues. But you can just be confident that you've offset that. There's another way to express it. Well, I'll just stop there. So the bottom line here is 8.5, 5.3. So any questions on that? So again, since we shortchanged H 400 tax depreciation here, we effectively shortchanged G 400 depreciation there and give it to H. So there's another way to express it, which might be a little more clear. Let's go back to the general rule. I mean, it's fine for you to look at it, do it this way too.
Wait, can you tell me what this reg is one more time?
-3 C4 example 2. It's good if you have you should have your book open. You could have it like in next to you, and you can see what I'm doing is consistent with what they're doing. -3 C4 example 2. So how we started, we had this was 1, this was 0.2. So another way to express it, if you'd like, is you can make the curative allocations as a separate line. Say, okay, we got to give H another 400 tax depreciation, and we can do it. That's the key. We have enough. So you could just express it like this, and then you give the offsetting curative, effectively ordinary income to G. I'm fine either way. You're doing the same thing. You're just taking, instead of collapsing into one line, you're doing it to 2. But that's fine. But remember, you can't give an extra 400 of tax depreciation that doesn't exist.
Quick question.
Yes.
Your notation on the right side with year 1 G1 and then year 2 H1.
Yeah, I'm sorry, year 1.
That
sorry,
okay?
That's a mistake.
Okay, cool.
Yeah. Well, this is all year 1. So all we did is, again, we did traditional for both, and then we cured the ceiling rule limitation on H with another item of depreciation from another property. The operating income is kind of a red herring here, so you have to really focus on it. Okay, so it's like 2 wrongs make a right, right? We're not allocating this perfectly, you know, we have a ceiling rule, and then we're gonna not allocate this perfectly either. It's a little bit harder to see because we have two types of 704C property. But yeah, so another way, like here, we're not getting this right, but we are getting this right under traditional. Under curative, we're gonna get this wrong and this wrong, but they're gonna be both wrong in the right amounts. So 2 wrongs make a right. That's what I think about curative. Like 2 wrongs make a right. So that is curative. Okay. All right. Now we move to, and that's kind of, again, you know, we go fast here. We got these problems. You can work these problems. There's problems in the book. We're gonna have a big set of problems on Wednesday. So we got lots of attempts, lots of opportunities to do this. But none of this is really hard thus far. The hardest thing, you don't have to worry about example 3. So again, keep track of which examples are useful. Example 1, example 2 in curative is very useful. Example 3, you don't have to worry about. All right, so go to remedial. So here's the curveball with remedial, and it's changes. It's this D2 dash 3 D2 rule. And what it does is it says you change the amount of book items attributable to contributed property in the following manner rather than the general rules. So we're going to change the way you calculate book depreciation when you use remedial method. This is why the remedial method is not necessarily always a win for the non-contributing partner with respect to built-in gain. You think it might be a win because you can make it up. You make it up, you don't have to rely on there being actual items to cure. But we're going to see that the book depreciation is slowed down, and that has ripple effects. So how do we calculate the book depreciation when we use remedial? And it says you're going to break the property up into 2 pieces. The portion of the partnership's book basis equal to its tax basis is recovered in the same manner as the tax basis. So the tax basis portion of your book basis is depreciated at the same manner as your tax basis, straight line over the remaining period. Then the remainder of the partnership's book basis, we call it the excess book basis, is recovered using any recovery period available to the partnership for newly purchased property of the same type as a contributed property. So that excess book basis is going to be depreciated like it's a new piece of property of the same type. And so with straight line, which is what we're going to use in this class, that means you're going to basically start the recovery period over. So you'll need to know the remaining recovery period, and you'll need to know the original recovery period. So let's see how this works. Again, we got a good problem here. We go to D7, example 1. Simple facts, L&M, 50-50 partners, straight line method, tax basis of 4, book value of 10, straight line method, 10-year recovery period. So that's the original recovery period, has 4 years left. M is going to contribute cash, which partnership uses to purchase non-depreciable land, right? Land which is non-depreciable. So again, we put this, it's pretty straightforward stuff to start. They're each contributing 10 of value, so their book capital account is 10. L's tax capital account is 4. M's tax capital account is 10 because M's contributing the cash. And they've got the land here, which is not 704C property, and it's not depreciable. And they've got the depreciable property, again, we'll call it machinery. Book value 10, tax basis of 4. And they use the remedial method. So the key here with the remedial method, again, this is the big curveball, that when you have a remedial method, we're going to change the way we calculate book depreciation. Tax depreciation is still the same. We've got 4 tax basis and 4 years left on a straight line basis. We get 1 a year for 4 years. So year 1, year 2, year 3, and year 4, we're going to get 1 per year. of tax depreciation. That's 168 I-7. That doesn't change when you use remedial. We're going to change the book depreciation. And so for book depreciation, what it says is that rule dash 3D2 says you take the book value of the 704C property and you break it up into two pieces. One piece is the piece that equals the tax basis. And the other piece is whatever's left, the excess book value. It says you depreciate the tax basis piece just like the tax basis. 0.1 a year, 4 years. You take the excess book value, 6, and you treat it like it's a new machinery placed into service this year, which would mean you start the recovery period over 10 years. So you're going to get 0.6 a year for 10 years. All the way to year 10. And your book depreciation total is going to be the sum of these amounts. So that means for years 1 through 4, your book depreciation would be 1.6. For years 5 through 10, your book depreciation would be 0.6. I'm going to explain why. I mean, I'm sure many of you are thinking, like, why? Other than, is this just sadism on the part of the reg writers or what? There's a reason, but that just means that for the first 4 years, we're going to get 1.6 of book. We get to year 5, we're going to have 0.6 of book and 0 of tax. That's going to be the same all the way to year 10. So instead of spreading the book basis over 4 years like we did with traditional, 2.5 a year for 4 years, we're going to spread it over 10 years, 1.6 a year for 4 years, and then 0.6 a year for the remaining 6 years. Okay, and again, this is 1.704-3D2, special depreciation rule for remedial only. If the method we are using is traditional or traditional with curative, then the book depreciation is just 2.5. You got 4 years left, 10 a book, we divide it by 4. Okay, any questions on the book depreciation calculation? All right, so what impact does this have? Well, we go to year 1, and we have our depreciation on the machinery, 1.6. Again, they're 50-50 partners, so we allocate 0.8, 0.8. We go give the non-contributing partner 0.8. And whatever's left goes to the contributing partner, 0.2. So we don't have any serial problem with M. So we'd have to do remedials in year 1. And just for quick comparison, what if we had done traditional, just for a second? If we had done traditional, the book depreciation year 1 would be 2.5. So we divide that 1.25, 1.25. And then we'd say, okay, give M, the non-contributing partner, tax equal to book. We only have 1 to give. Whatever's left goes to L. So this is why actually traditional, even though it's ceiling rule limited, is better for M in year 1. Just looking at M1, year 1 by itself, because M gets 1,000 of tax depreciation, but 800 in year 1. under remedial. This is where M might prefer traditional. And that gets to why we have this crazy rule, this curveball rule. The reg writers wanted to slow down the book depreciation because they were worried that tax planners, given the opportunity to make stuff up out of thin air, would play games and get results that were abusive. And so they slowed down the book depreciation. When you slow down the book depreciation, you reduce the likelihood and significance of remedial allocations in the early years. And this will be the same for years 1 through 4. We would never have remedials. Let's do years 2 through 4 together, just combine. We're basically multiplying everything by 3. So we get 2.4, 0.6, 2.4. So in years 1 through 4, we would never do remedials. We get to year 5. Well, now we're going to have remedials because now we're here. We've got 0.6 of tax depreciation. So that'd be, I'm sorry, book. That would be allocated 0.3, 0.3. We try to get M tax equal to book. We have no tax depreciation. Whatever's left goes to L. There's nothing left. We would now have year 5 remedials. We invent 0.3 of tax depreciation, give it to M, and then invent 0.3 of the opposite of tax depreciation, which is ordinary income, give it to L. So because of the special book depreciation rule, we didn't have remedials in years 1 through 4. We kicked them down to year 5 through 10, and therefore would make creative tax planning a little bit harder if you wanted to abuse this. There's paranoia here of that whenever you give taxpayers ability to sort of invent out of thin air depreciation deductions, you're going to do that and try to do it. You're going to try to give it to partners that like depreciation, like taxable partners with high marginal rates. And then you'll give the offsetting fictional gain, fictional income to partners that don't care about income, like tax-exempt partners or partners with NOLs, net operating losses, or the like. And so because of that paranoia, there's this, again, slowing down the book depreciation to reduce the significance of remedials by delaying them. And here it works, it delayed them. Because again, if we were using remedials here, if we did the same book depreciation, we'd have remedials in year 1 of 0.25 to M. We can just combine year 6 through year 10 in another line, just multiply this by 5. We have 1.5 remedials would be and at the end of the recovery period, you would end up with 5, 5. So that's that. So again, it's really not that complicated. You have to know if you have an exam question that says we're using the remedial method and you have depreciable property, you got to calculate the book depreciation in this weird way. And that's step 1. That's part of step 1. Calculate the book and the tax items. Well, calculate the book items. It's book depreciation. If it's depreciable property, again, you'll have the fact pattern. It'll say equipment or machinery or depreciable property or whatever. Then you got to worry about it. If it's land or inventory, it's non-depreciable. You don't have to worry about it. Okay, questions?
Yeah. Why do we have 0.3 of tax depreciation in year 5?
We don't have year 3 of tax in year 5. We have for year 6, we have 0.6 of book depreciation. That's
split, and then
and then we have 0 of tax.
What is that line that says?
These are remedials.
Oh, you did a remedial in year 5,
yeah.
and did you do a remedial after that too?
Yeah, this is when we're combining a year 6 through 10 all in one line.
Oh, okay. We're just not doing it step by step.
Yeah, I mean, you could, I don't have enough room. And if you did, it gets repetitive if you do it. I mean, you could do it. And it's not a bad, but if you did years, you could do this all, you have a depreciation schedule with 10 lines. But year 1 and year 4, year 1s, 2, 3, and 4 are all the same. And years 5 through 10 are all the same. So once you do one, you know how to do the rest.
Why do we do a remedial in year 5?
Because we have our non-contributing partner is M, is getting 0.3 of book depreciation, should get 0.3 of tax, but is only, so there's the ceiling rule, book tax disparity, ceiling rule limited. Remedials cure the ceiling rule limitation. Okay,
that's confusing to me because it looks like by the time we're done with year 4, we've already hit all $4,000 of the adjusted basis.
No, it's not the 4,000, it's the 6, a built-in gain.
Okay.
That's what, all we're doing is getting, is basically taxing L on that 6 of built-in gain. And we're taking depreciation away from him to do that. I mean, if you think about it, I mean, you can think about it conceptually, that's fine. Some people like to just follow the rules. And if you follow the rules, you'll get the right answer. But what the idea here is that M is really buying half of the machinery. And if M buys half of the machinery, M should get, depreciation deductions based on 5. But there's only depreciation deductions based on 4. So that's the problem that we're dealing with here. But yeah, it's the 6 of built-in gain that we're withering away through this by allocating depreciation disproportionately more to M. That's what we're doing. We're giving M more of the tax depreciation, L less of it.
Okay, is it weird to think about this like in terms of, well, there's only $4,000 of a tax basis, so why don't we stop the depreciation allocations once we hit 4,000? Like, why base our tax allocations on the built-in gain?
Right, because again, M, it's like M is buying half of its property. And if M had bought half the property for 5, then M would get depreciation deductions over the life of the asset of 5, right? But so that's the idea. We're trying to put M in the same position as if M had bought the property, bought half the property.
Okay, yeah, that makes more sense.
Yeah, we're trying. Yeah, it's another way of saying we're trying to make sure that L gets it's getting this benefit of getting 10 of book value, but it only paid tax on 4. And we're trying to account for that in allocating the depreciation. And remember, if we don't fix it this way, it's going to be fixed at the end. At the end eventually. Let's go back to the regs here. So again, just with remedial, and here's the rule. If the ceiling rule causes the book allocation of an item to a non-contributing partner to differ from the tax allocation of the same item, the partnership creates a remedial item of income, gain, loss, or deduction equal to the full amount of the difference and allocates it to the non-contributing partner, and then simultaneously creates an offsetting remedial item, identical amount, allocates it to the contributing partner. So it's this sentence right here. This is what we're doing here. That's what we've done. There for year 5 and here for combining years 6 through 10. We said M, the non-contributing partner, didn't get her full share of tax depreciation. Well, let's invent some tax depreciation and give it to her to eliminate that. And then we're going to flip it around and give the opposite to L, the contributing partner. So that is D7 example 1. Two-little i's does years 1 through 4, which is what we just did. Sorry. And then in 3 little i's, we do, this is 5 through 10. And this is showing the remedial allocations. And at the end, we did example 2 remedial. This is Blackacre. So there was no depreciation. So we did that last class. That's a good example. Example 3 is another example. I'll just do that one because we got 5 minutes. It's a simple example. And then we'll be done. So this is Blackacre. So it's non-depreciable property. So if you see a problem and it's 704C property involving land, then you say, oh, it's easier. I don't have to worry about this depreciation stuff. So here we got N and D. N is contributing the Blackacre. Book value is 10. Tax basis is 4. D is the cash partner, contributing 10 of cash. So you got the land here. And it's sold for 3. So we're selling the land for 3. So you sell 704C property, again, non-depreciable, we don't have to worry about any depreciation. Upon the disposition, that's when we deal with it. Sell it for 3, we got 7 of book loss. And 1 of tax loss. Amount realized is 3, book basis is 10, tax basis is 4. So 0.3 of, 7 of book loss allocated 50-50. So each get 3.5. Give the non-contributing partner tax loss equal to book loss. But the ceiling rule says we can only give D1, that's all we got. Whatever's left goes to contributing partner, we got nothing left. So with traditional, we just stop there. But we've elected remedial. And so with remedial, again, we look at the non-contributing partner and we say, oh, non-contributing partner got shorted 2.5 of loss. Let's say it's a capital loss, long-term capital loss. So we're going to give D 2.5 of long-term capital loss. Made up out of thin air, but goes on the return. Reporting a transaction, reporting something that doesn't exist. It doesn't exist. It's phantom, it's fiction, but it's fiction that counts. So we're going to fix that. Again, we've now given D the full amount, and then we give the opposite amount to N. Again, focus on the non-contributing partner. That's how you get the 2.5. That's going to make it more clear. And so N is going to get 2.5 of gain. And so at the end, you're going to have resolved the book tax disparity. So that's example 3. Let me just tell you something, note here, you should annotate this. And there's a mistake here. I mean, this This is in the CCH. It's not even the abridged version. It's in the actual regs. So the abridged version just copies exactly what's there, but that shouldn't be negative. That should be positive. So N is getting an offsetting allocation of capital gain. It's not reflected correctly here. It's not, they get it right here. Just a typo. Okay, questions on that? So all those examples, the examples in the book, there's a bunch of examples we've just done in the regs. I would work on those examples. I'd prepare the examples, the problems for class on Wednesday. So we have another big set of problems doing the same stuff. And if you keep working these problems, again, if you want more problems, there is that Cunningham book, The Logic of Subchapter K. I'm going to check and see whether that's on West Academic. So I wouldn't buy it until you check it's on West Academic. Make sure it's not. But more examples. You can create your own examples. You don't need a whole lot of imagination. Value, property, basis of property, remaining recovery period. You can adjust all those things. And by the, hopefully soon, you get it comfortable with all this stuff, because there will be a 704C problem on the exam. It's important. And so you'll see something certainly on 704C in the exam. Okay. Any questions? All right, well then I'll see everybody on Wednesday. A reminder, as I mentioned earlier in class, no, we won't have class on Monday and Tuesday of next week, contrary to the syllabus. So you can plan for not having those classes. Okay, see everybody on Wednesday. Bye-bye.